This week's global macro picture was shaped by four dominant forces: geopolitical risk, shifting monetary policy expectations, uneven growth dynamics, and re-emerging trade tensions. But beneath the surface, there's a lot more going on, especially across credit markets, housing, consumer behavior, and global capital flows. Let's go region by region and break it all down. Starting in the United States, where the macro story is becoming increasingly complex. On the policy front, regulators are preparing to ease capital requirements for large banks, potentially unlocking tens or even hundreds of billions of dollars in lending capacity, share buybacks, and dividends. This could act as a quiet but meaningful form of financial easing, even as monetary policy remains restrictive. At the same time, the U.S. Treasury introduced a 30-day waiver for purchases of sanctioned Russian oil, aiming to stabilize global energy markets disrupted by the Middle East conflict. But the growth data is clearly softening. Fourth quarter GDP was revised sharply lower to just 0.7%, while real consumer spending showed almost no growth in January. Housing is also under pressure, with new home sales falling to their lowest level since 2022, as mortgage rates continue to rise. Inflation, however, is not cooperating. Core PCE surged to 3.1% year over year, the highest in nearly 2 years, reinforcing the Federal Reserve's cautious stance. And that stance is clearly visible. The Fed held rates steady, signaled a hawkish bias, and markets are now pricing only about a 50% chance of a rate cut this year. Meanwhile, global bond markets sold off, as investors scaled back expectations for easing amid rising oil prices and inflation risks. Looking deeper into the consumer, an important divergence is emerging. High-income households are driving spending growth, benefiting from stronger wage gains, while lower-income cohorts are lagging, suggesting an increasingly uneven consumption dynamic. On the market side, risk sentiment is deteriorating. Money market fund assets have surged to record levels. Cash allocations among fund managers are at their highest since March 2020, and concerns are building around private credit, where default rates are expected to rise toward 8%. Partly due to AI-driven disruption in the software sector, even corporate structure is being reconsidered. The SEC is exploring changes to earnings reporting frequency, potentially shifting towards semi-annual reporting, for some firms another sign that market structure itself is evolving. China, by contrast, is showing signs of stabilization and even resilience. Economic data for the first 2 months of the year surprised to the upside, with stronger investment, industrial output, and consumption. Fiscal spending is accelerating at its fastest pace since 2022, and credit expansion has picked up meaningfully. There are also early signs that the property sector downturn is moderating, supported by targeted policy measures such as lowering down payment requirements in Shanghai. From a structural perspective, China appears relatively insulated from the global energy shock. With access to cheap power, strong oil reserves, and advances in renewable energy and battery storage, China is less exposed to the inflationary effects of rising oil prices. However, challenges remain. Youth unemployment, while improving, is still elevated. Fiscal revenues are declining, even as spending rises, pushing deficits higher and long-term confidence remains fragile. At the policy level, Beijing is also pushing forward with structural reforms, including considering a unified national framework for local subsidies, restricting overseas IPO pathways, and accelerating technological self-sufficiency, particularly in AI chip development. Geopolitically, tensions with the US persist, with China urging the removal of tariffs and both sides exploring new mechanisms to manage trade relations. So while China is providing a near-term growth boost, the longer-term outlook remains uncertain and policy-dependent. In Europe, the narrative is shifting toward tightening financial conditions. The European Central Bank held rates steady, but markets are now fully pricing a rate hike by July, and a high probability of another by year-end. This is a dramatic shift from earlier expectations of rate cuts, driven largely by concerns that energy prices could trigger a renewed inflation cycle. In fact, ECB projections suggest inflation could peak as high as 6.3% by early 2027 if geopolitical tensions worsen. At the same time, structural developments are unfolding. Germany is pushing back against a major banking consolidation move. The EU is advancing trade negotiations with both the US and Australia, and policymakers are exploring ways to simplify capital rules to unlock more lending capacity. Fiscal policy is also becoming more expansionary. Germany has earmarked $600 billion in military spending, which is increasingly acting as economic stimulus. In Canada, the macro picture remains fragile. Retail sales remain solid for now, rising 0.9% in February, but this strength may prove temporary as higher oil prices begin to squeeze household spending. Inflation has eased to 1.8%, but beneath the surface, growth risks are building. Population growth has turned negative for the first time on record, driven by tighter immigration policies, and public sentiment is shifting sharply toward lower immigration levels. This has direct implications for housing demand, labor supply, and long-term growth potential. At the same time, Canada's ability to ramp up oil production is constrained by infrastructure limitations, maintenance cycles, and environmental risks like wildfires. On the external side, trade uncertainty is rising. U.S. negotiations with Canada are lagging behind Mexico ahead of the North American trade review, creating risks for Canadian exporters. The Bank of Canada, for its part, is holding rates steady and watching closely, but the balance of risks is clearly shifting toward weaker growth. In the UK, policymakers are preparing for a more difficult inflation environment. The Bank of England held rates steady, but markets are now pricing multiple rate hikes in 2026, driven by the expected impact of higher energy prices. Internal models suggest the central bank may need to respond more aggressively than previously anticipated, potentially shifting sharply toward a hawkish stance. At the same time, fiscal pressures are intensifying. The budget deficit is widening, debt servicing costs are rising, and household bills are expected to increase significantly due to the energy shock. On the structural side, the UK is also working to strengthen trade and financial ties with Europe, while investing internationally in infrastructure projects. Finally, in Japan, inflation dynamics are slowly shifting. The Bank of Japan signaled that underlying inflation is moving toward its 2% target, but the yen remains weak, hovering near multi-decade lows. Rising oil prices complicate the policy outlook as they increase import costs while limiting the scope for intervention. Meanwhile, Japan continues to deepen strategic ties with the US, including joint investments in energy infrastructure. So putting it all together, we are in a macro environment defined by asynchronous policy paths, persistent geopolitical risk, and diverging growth trajectories. The US is slowing, but inflation is sticky. China is stabilizing, but structurally fragile. Europe and the UK are turning more hawkish. Canada is facing rising downside risks. At the same time, financial markets are signaling caution. There is rising cash allocations, weakening bond markets, and growing stress in private credit. For investors, this reinforces three key themes. Commodities remain a key hedge against geopolitical risk, and carry strategies dominate in fixed income, but with limited conviction. If you found this deep dive helpful, don't forget to like, subscribe, and share your thoughts below. And I'll see you next week for another macro roundup.